yesterday's close. And really, aside from all of that, I think this is really what's important. We have a low 2, low 1, low 2. We're getting a reversal up. So we have a decent bull bar here. What happens if tomorrow is another strong bull bar? Traders will begin to wonder, what if we get a measured move up of this bear flag and we go back up here, 6,000? There's all sorts of targets above. Weekly chart. Here's the weekly chart. 4 consecutive bear bars, but body's getting smaller, just more disappointing as it's going down, and we're starting to reverse up. So we're probably going to bounce, and I think we'll probably get up to this area up here at some point. I was long, and I got out. I don't remember where, somewhere. I don't know if I'm guessing 713. I got out somewhere in here. Do I care that the market went up another 10 points and maybe it goes up another 20 points and I'm not in the trade? No. I heard someone make a comment that it's really important there's a difference between being right in relation to the market and being right in relation to you. When you look at the market, you have to think about being right in terms of what is best for you. That does not mean extracting as many points as possible. So I got to do one thing really quick, and I'll start the review here in about 5 minutes. But obviously, end of the day, if you're in a trade, you should close it. One of the things that's important to always remember is you have a lot of trading range price action, and then you get a breakout. And the breakout looks strong. However, it's only a few bars above the overall range. When you see that, one of two things, generally, because sometimes you get just a strong rally, but a lot of times the market just goes sideways for a lot of bars and becomes a trending trading range kind of day. What's the greatest, for those of you in Discord, and I'm curious, what's the highest probability type of open? In other words, what should you expect on the open? Trading range. Good answers. And how often do you get a trend from the open? And then another thing I want to mention really quick, in case I forget to say it, 3-bar micro channels. So this is something that overall, let's look at all the 3-bar micro channels on this chart. So here's a 3-bar bear micro channel, failed break out of this range. But here's what's interesting. Well, first let me back up. How many 3-bar micro channels get second legs? 3-bar bear micro channel, price went above this high. 3-bar bull micro channel, pulled back, second leg. 3-bar bull micro channel, bull bar. 3-bar bear micro channel, second leg down. Bull micro channel, second leg up. Another bull micro channel, reversal. So here's the interesting thing. It's common for, in a trading range, for something like this to happen. 6, 7, and 8. Or you can say 6, 7, 8, and 9 because it's a 4-bar bear micro channel. And theoretically, if you sold there, if you sold the close of 8 and you put a stop above 7, you got stopped out. But here's what's interesting. If you were to sell here, sell this close, and put a stop, let's say, somewhere way, way up here. If the market was to pull back, let's say 70%, a lot of times you can get out break even. So that's what traders do all the time. They're not going to actually sell. This is a really bad example. They're not going to necessarily sell down here. But the point is, even if you did and you scaled and higher, the market still let you out. A better example is yesterday. Not a great example, but we had a 3-bar bull micro channel, 26, 27, 28. And if you put a stop, a measure move down of the micro channel, somewhere down here, this pulled back. And when I say 70% or 75%, it's 70% of the actual range of the breakout. So if it pulls back somewhere down here and you scale in lower, you can get out break even. A lot of times when the market does something you don't want it to do, it's generally better to get out break even and move on to the next trade. Give me 2 seconds here. Yeah, sorry. Full transparency, I didn't have a big lunch, so I had to eat a snack really quick. All right, so let's see here. So the weekly chart, talked about that a few minutes ago, but we're getting a sell-off, tails below the bar. Odds are we're going to bounce and probably test this breakout point over here back in January. Why would we test the breakout? Why would we test the breakout point? Because the reality is it's a trading range. Trading ranges fill breakout points. I think Tim Stout mentioned a couple of days ago, or sometime last week, that this sold off and tested the breakout point here, and he's right. So just another example of breakout points getting tested. The bears have done a good job with the selling. But what do the bears need in order to get a credible topping pattern? They have a bull trend. They have a trend line break. They need a higher high. They need some form of a major trend reversal. But the reality is, here's the issue. That's the monthly chart. So even if the market starts to go sideways, which I think it will, I think ultimately we'll get down to this breakout point here, and at some point we'll probably get down to 5,000. That wouldn't surprise me, but that could take a very, very long time. Realistically, on the weekly chart, we're probably going to bounce 6,000. That's a credible. I got to get a new mouse. 6,000. That's a credible round number. Makes sense for the market to try and get there. There. Daily chart. There's going to be 2 seconds here. All right, anyways, daily chart. We had a low 2. We got a reversal up today, which not really, it was reasonable for that to happen. I thought we had a low 2 at the bottom of a trading range. Whenever you get a second entry at the bottom of a trading range, it's common enough for it to fail. Here, it's an inside bar. That lowers the probability even more. And we're really far away from we're far from the moving average in an overall trading range. And we have magnets above. So here, I thought the odds were it was going to fail. You can basically see it formed a double bottom. So it's a smaller, higher low double bottom major trend reversal. Not really a great example, but it's a double bottom right here. So if we go to you can see it on the 60-minute chart. 60-minute chart, tight bear channel, rally, sell off. Bulls want a higher low major trend reversal, but it's really common where the market will often form a double bottom higher low major trend reversal or a double top lower high major trend reversal for the bears. The reason for that is relatively simple. You have something that's really tight like this. You get a trend line break here, and you get a sell-off that just doesn't last enough bars. And because of that, you get a rally that creates a double top. The bears, they see this as a double top, and they want trend resumption down. The market sells off, and now it forms a double bottom, and they want trend resumption up. Does anyone remember the 60-minute chart I talked about earlier this morning, how you had a bull bar for the first 60-minute bar yesterday right here? And if you use a stop, this is kind of that same logic I was talking about with 3-bar microchannels. It all works the same way. If you put a stop, a lot of traders aren't going to put a stop here. No one's going to buy this close and put a stop right there. I think it's just kind of a dumb trade. If you're going to do that, you're going to buy, and you're probably going to get out below a bear bar and then look to re-enter. And then realistically, what are traders going to do? If they don't get out here, they're not going to get out below this bar. This is 2 legs down, and look what happened. If you bought up here and you bought more lower, this is probably going to rally and allow the bulls out break even. I think realistically, what do I think is going to happen? Probably Monday, if not Tuesday, we're going to go back above that red line and allow those bulls out. 5-minute chart. Let me fix the scaling really quick. There we go. We had a gap down on the open, and first bar of the day formed a doji bar. For the bears, not a good sell below. For the bulls, not a great buy above. But because it's a gap down and yesterday's low is right here within reach, my one thought coming into the day is we're probably going to test yesterday's low. 2, we tried to break below 1. It's a second leg down after the gap. So we had a gap down. We tried to reverse up on 1. We sold off on 2. But really not good for the bears. No one's going to sell below 1, and clearly they're probably not going to sell below 2. What about buying above bar 2? You can argue a micro double bottom, but if you're buying down here, you really need a wide stop. So low probability sell below 1, low probability buy above 1 or 2. And then 3, we broke above 2 and we broke above 1, but it looks like we're finding sellers. So not a good buy above 3. Looks like we're going to be in a tight trading range. If I had to pick a direction, I'd be long using a wide stop. But most traders should not do that. Doji 4. For the bulls, they see it as a pullback from 3 and they want a second leg up on 5. And instead we found sellers above 4 and we sold off on 5. The one thing we notice here is we've had 4 bull closes, 4 bars closing above their open and 1 bar closing below its open, but all bars closing above their midpoints, even bar 2. And that's a subtle sign that the buying pressure is greater than the selling pressure. 6, another bull bar, good for the bulls. We're starting to get trending closes. Every close is at or above the prior bar. Increases the odds that we're going to go higher. 7, bear breakout below 6, but looks like more traders buying below. Not a good sell below 6, not a good sell below 7. Looks like there's more buyers down there. What about buying the low of 6 and putting a stop below 2? I think that's just generally a bad idea. Because the reality is, what do you think is below 2? There's probably more buyers below 2. So if we went below 6, putting a stop below here really doesn't make all that much sense. And then you can see what happened with the next bar. We had a bear breakout on 8. Good for the bears. We make it a small second leg down. What about selling the close of 8? I would not. You're selling at the bottom of a trading range and with a lot of overlap. And as far as buying the close of 8, you really need a wide stop. Buying the close of 8, stop below 2, not ideal. And you can see what happened on 9. 9, reversal up, good for the bulls. 4 bar bear micro channel. Increases the odds that there might be sellers above 9. But bears who sold the close of 8, disappointed on 9, they'll probably use whatever pullback they get to get out break even. 10, bull bar, not a great bar for the bulls. A hesitation bar increases the odds that there's sellers somewhere above. But I'm not, as far as if you had to do anything, it's probably long above 9. 9 and 10, we have a bull reversal bar and a bull entry bar, probably buyers below 10 and a second leg up. 11, 3 consecutive bull bars, but 11, a little bit of a bigger bar after 9 and 10, increases the odds that the market may pull back. 12, a bear bar. They'll see it as a failed breakout above 6. But as far as selling below 12, I would not. It's a micro channel from the low of 9, and the odds are we're probably going to get a second leg after 9. What about the bears who sold at the 9 high and scaled in? They may, I suspect, the market's going to allow them out break even. They sell the high of 9, they sell more higher. They'll probably be able to get out break even, but probably buyers below 12. 13, high one buy, breakout pullback buy, but not a great stop order above, so probably sellers above. And then 14, outside down, good for the bears. What about selling the close of 14? It's 2 legs down after a decent rally, 9, 10, and 11. Plus, we have, let me go ahead and draw it just so we can remember it's there. Plus, we have yesterday's low right here. And that increases the odds we're probably going to get there. 15, reversal up, good for the bulls. Probably going to get at least a second leg up after 9, 10, and 11. 16, follow through after 15, good for the bulls. Probably buyers below in the second leg. Then we have another bull bar, 17. For the bulls, 3 consecutive bull bars, probably going to break out above 12. And then 18, we've got the breakout. What about buying the close of 18? There's nothing wrong with buying the close of 18. The one problem with 18 is 18 is the first, really the only bar of the day breaking out of the 17 bar range. So we had a 17 bar tight trading range, and 18 is breaking out, and it's trying to undo the gap down. That increases the chances that increases the risk that 18 is some kind of trap. But as far as selling 18, no way. 18 is strong enough that we're probably going to go higher. Then we got a bear bar, 19. For the bears, for the bulls, for the bears, it's 2 legs up and a second leg trap. Rally, pullback, second leg trap. That increases the risk for the bears that that increases the risk for the bulls that we could test all the way down to the 15 low, the bottom of the second leg. Some bulls who bought the close of 18 will be disappointed at 19, and they'll try and get out break even at the 18 close. And you can see what happened on 19. It allowed traders out. 19, high one buy, probably sellers above, second leg down. 20, high one buy, sellers above, second leg down. 21, good for the bears, probably going at least a little bit lower. 22, follow through, so probably a second leg down, likely. And then 23, we have 3 consecutive bear bars, probably sellers above, and a second leg down. 24, another bear bar, but body's getting smaller. Looks like we're going to pull back. Then you can see what happened. 25 tested all the way back to the 21 close. If you're a bull, some bulls, somebody bought the close of 21 thinking it's a pullback, it's pullback, it's 2 legs down. It's probably a bull trap. It's probably a bear trap. And then you can see what happened. They were disappointed, 22, 23, 24. Some of those bulls set limit orders back at 21 to exit their trade. So the close of 21 is 78.25. The high of 25 is 78.5. So the price went 1 tick above 21. You have the bears. They know that. They're not stupid. And when they see 21 get followed through, 22, 23, 24, you have plenty of the bears that will actually end up setting limit orders to sell back at the 21 close. 25, breakout, pullback, sell, but not a good sell signal bar for the bears. It's a low one in a bull bar. I suspect buyers below, but buyers may not come in until we fall below something like 15. And then we got a bear bar on 26, probably buyers below, but again, buyers below could mean down here. Odds are we'll probably go under 24 and get a second leg. 27, bear breakout, testing the 15 low, but only 1 bar, and 26 is an inside bar. Increases the risk that 28 is disappointing. 28, bull bar, retesting the low of 26, the price level where the bulls got trapped buying the 26 low and more lower. 27 might be strong enough that there might be sellers above 28, but even if there are, there's probably buyers on a test of the 27 close. So selling, really not that ideal. Then you can see the bears, they got a small second leg down with 29. 29, second leg down, 27, parabolic wedge, 24, 27, 29. Not a good buy signal bar above, but it's a warning that we may not go much lower before we may not go that much lower. 30, second entry sell. We had an inside bar, 28, and then we tried to break above 29 and we reversed down on 30. 30, it's an okay sell for a swing. Well, let me say it different. 30, you have some bears taking the sell, betting on a second leg, betting on a breakout below 29 and the test of the 9 low. But a small signal bar, I would not take that. I think it's really too close to support. Then you can see what happened. This is if you sold below 30, price went down below 29, or price went down below 28 and reversed up on 29. A lot of bears, when they take that trade, they know 30 is a low probability trade and that they're probably going to lose money. And therefore, if they're taking the trade, they need the trade to work relatively quickly. And if it doesn't, if it sells off on below 30, as it did on 31, hesitates at the 28 low, and then starts to turn up, a lot of those traders will buy back their shorts. It's the same thing with selling below 6. If you sell below 6, betting on a parabolic wedge and a second leg down, if 7's your follow through and 8 is more follow through selling, but there's a lot of overlap, traders are going to be quick to exit. 31, bull reversal bar closing on its high, second entry, testing near the close of bar 8. Let me see if it reached it. Close of bar 8 is 6.75. The low of this bar is 8.75. So we didn't quite reach it. But reversal up 31, follow through 32. 18 was probably strong enough that the odds are we may test it. This is actually really common. Let me make this range actually bigger. It's probably hard for some of y'all to see it. This is actually really common for a situation in the market. You get two legs up in an overall trading range. So two legs up, it's basically a second leg trap. It's really common for the market to fall below the second leg, only to reverse back to the close of the at the end of the second leg. So here's the bottom of the second leg. You can see price went below it. But if you're a bull and you bought this close and you scaled in lower, you made money. And that's really common to happen. 32 consecutive bull bars, probably going at least a little bit higher. 33, more follow through buying. 3 consecutive bull bars, 31, 32, 33. Good for the bulls, increases the odds that we'll get a second leg up. And 34, another bull bar for the bulls. Probably buyers below and at least a second leg, but the buyers may not come in until we get a couple of legs sideways to down. And then 35, another bar for the bulls, good for the bulls. But what do you notice? What do you notice is different about 35? 35 has less of a tail below and above the bars than relative to 34, and that's a sign of climactic behavior. Increases the odds that we pull back. 36, bear bar, probably buyers below, but not a good stop entry above, and therefore we may sell off, pause, and get a small second leg down. 37, outside up, disappointed bulls that bought the close at 35, disappointed 36, getting out break even. 37, we got a second leg down. 38, but 38, really not what you want to see if you're a bear hoping for a second leg trap. Typically, to get a second leg trap, as far as selling here, I would need to see a credible stop entry sell. And really, 31 to 35 is really too much buying pressure. Too many bull bars for me to be buying up here. 39, inside bar for the bears. Bears are hoping they get the downside breakout. But again, if you're selling 39, you're selling what's likely the bottom of a trading range. So as far as taking that trade, I would not. There might be more traders buying below 39 or on the close at 39 and selling it. It doesn't look like it. It doesn't look like it, but it's basically a parabolic wedge. 36, 38, 39. And because of that, there's increased risk that more traders will buy down here than sell. So leg 1, leg 2, leg 3. $40 reversal up, good for the bulls. Probably going to get at least a second leg up as far as buying the close of 40. Some traders will, but probably going to get bad follow through. 41. And then 41, a bull bar, good for the bulls. Probably going to get at least a second leg up. So probably buyers below 41 and a second leg up for the bulls. 42, bull bar closing on its high, good for the bulls. But notice what happened with 41. We had a bull bar 40 and then a pause 41. And now we have a bigger bull bar 42. That increases the risk that 43 might be disappointing for the bulls. 43, bear bar, strong enough reversal. It'll probably get a second leg down, but it's reasonable to buy 42. And therefore, bulls buying the 42 close and more lower probably will make money. Bull bar 44, but probably sellers above and a second leg down after 43. But sellers above and second leg down does not mean sell above and hold for a swing, testing down here. What that means is minor reversal. So probably sellers above 44, and we'll probably test down to maybe the 42 low, the 43 low, somewhere in here. Outside down 45, strong enough bar, we may go a little bit lower, but 43, a bear bar, and then a bull bar 44, 45, a bear bar, chances are 46 is going to be disappointing. And look what happened. Instead of it being disappointing, it was a follow-through bar. That's strong enough that we may get another leg down. But as far as selling 46, it's a little bit dangerous. 47, outside up, good for the bulls, but we may get a second leg down after 45, 46. And then we got 48, third leg down, 43, 46, 48. increases the odds that there's buyers below 48 and will bounce. 49, a reversal bar. Close one tick above the open, so a bull bar. Not a great stop entry buy from the signal bar is weak, but the context is good. It's a fail break out of the 39 low. I mentioned there's this trading range bar right here, so it's basically right there, and the odds were buyers below 39. Always in bears, I'd get out above 49. Bulls will buy. And then we got a reversal bar, 50, good for the bulls, probably going at least a little bit higher, 51. Another bull bar, tail above the bar, but still probably buyers below in a second leg up. And then we got 52, bull bar, good for the bulls, probably going at least a little bit higher. And then we got a doji, 53. For the bears, they'll see it as an implied, you can call it a parabolic wedge or two legs up. So we had a wedge, 37, 42, and then 53. But then this rally here, the micro channel, 49, 53, it's climactic, and it's also subdivided into two legs. We have a bull bar 50, pause 51, bull bar 52, pause 53. So that's two legs up. Not a good sell below 53. But trading range day, this is actually a little bit tricky of a trade. Here, we had it's a little bit tricky to buy below 53. Even though the odds are it'll probably work. Why is it tricky? We had a bad buy signal bar, 49 here, and there's probably sellers above it. And that means bears who sell and scale in will probably make money, which means we'll probably test back to the 49 high. However, if you're a bull, there's probably buyers below this bar. And one of the things that's really, really common in trading ranges is that you sell above 49, the market rallies up here, and then the market will test back to the 49 high before these bulls make money. So bulls buy here, they get trapped here, and then the market sells off all the way down here before it goes back up and relieves these bulls. And in this case, it went a little bit lower, it got two legs down, and then tested back there. 54, a little bit of a surprise. If you're a bull and you bought the 53 low, you're disappointed. 54 increases the odds that we'll get a second leg. And I made the comment that the bulls need a relatively strong buy signal bar to undo 54. And 55 is really not that strong of a buy signal bar, so it increases the odds that the bears will get a second leg down. 56, second leg down, good for the bears. Not a good stop entry above the bar, but not a good stop entry below. Again, as far as buying the close, it's a little bit tricky because we had that breakout point down here. 57, bear bar, good for the bears, probably going at least 57, a bear bar, but not a strong bar, probably buyers below. But again, we'll probably have to test the breakout point. That's pretty common for trading ranges. 58, bull bar, second entry buy, but a micro channel, 53 high, 56, 57 high. There might be sellers above, but I think it's really tough to sell a bar like 58. It's a bull bar closing when it's high, and we're probably going to get back to the 52 close and allow those bulls who got trapped out of the trade. Outside down 53, a little bit of a surprise, probably going to get down to the 49 high. And then 60, consecutive bear bars, 59, 60. Good for the bears, but a wedge, 54, 56, 60. Probably more buyers down here than sellers. Bull bar 61, followed through 62. Good for the bulls, probably buyers below in a second leg. But what do you notice? 60 is a bad buy signal bar. It's a bear bar. 61 has a tail above the bar, and 62 has a tail above the bar. And all three bars, 61 overlaps a lot of 60, 62 overlaps a lot of 61. So all three of those bars have overlap, and that weakens the case for the bulls. 63, a bull bar, closing on its high. But what do you notice? It's similar to 35 right here. 63 has fewer tails above and below the bar. And 61 and 62 have more tails. Well, let me say it differently. It probably sounds confusing. 63 has more body than tails. 62 has more tails in relation to the next bar. In other words, these bars should be getting weaker. These bodies should be smaller. So the percent of the bar, the prior bar, so 63 has more body in relation to the percentage of the bar than the prior two bars. Even the bar is smaller. Both of those reasons increase the odds that we may pull back. Really close to resistance, the low of 53, where some bulls are disappointed. Bear bar, 64, strong enough reversal. We may get a small second leg down, so there might be sellers on a retest of the 63 close or the 64 high. But, again, I don't think it's that great of a buy. I don't think it's that great of a sell. And then 65, 66, we have an implied, it's a little bit of a second entry, breakout, pullback, sell, but probably more buyers below 66. As far as taking the trade, buying or selling, middle of a tight trading range, better to wait and see what the breakout, better to wait for the breakout. Best to assume it's 50-50 probability. 67, bear bar, 68, follow through, probably going to bounce. And we did on 69. 69, reversal up, good for the bulls. Two legs down, double bottom, 49. Increases the odds that we're probably going to go sideways and bounce. And then we got a lot of overlap. And then finally, the bears, they tried to break to the downside. They tried again here, they tried again here, and they failed 75, and then we reversed to the upside in the final minutes of the day. Fairly common thing for the market to do. For stop entries, let me talk about always in. I thought the first credible always in trade is probably buying above 9. If you get out below 12, which I don't think you have to, you buy again above 15. Bulls, if they can buy 15, 16, 17, any of those bars. And then what do after 18? Some will get out below 19. Others will get out as 21 failed to trigger the high one and started going down. Or they can get out below 21. Bears, if they're short, they probably get out, somewhere in here. If they're smart, they get out as 31 is going down and starts to reverse up. Certainly, they'd get out above 31. Bulls, they'll buy. And where do the bulls get out? I don't think they have to get out in here. Some will get out below 45, but if they do, they probably buy again above 47 or certainly above 49. Not all that clear. And then up here, even more difficult. If you're a bull, and first off, let me clarify, why is it difficult? It's difficult because you're not getting decent stop orders. Why are you not getting decent stop orders? I don't have proof over this, but the argument that makes the most sense for me is this. You have counter trend traders getting trapped consistently. So what happens is this. You get relatively bad looking stop entries to sell. So bulls buy it, they get trapped on the way down, and then they end up making money. You get relatively bad looking stop entry buys, 49, but the context makes sense. Traders sell it, scaling in, and they get trapped, and the market keeps retesting them. There's also the fact that you have traders that are buying and they'll scalp out at some percent, 1 or 2 times the range of the signal bar or at new highs. There's all sorts of reasons. But anyways, in a trading range, if you're trading always in, you're going to get bad signal bars, and therefore it's not going to be that clear as to where you exit. 53, bear bar, doji, I think it's okay. I think it's okay for bears to get out below 54, or as 56 went below 54. And then bulls, some will buy 58, but a little bit of a trap because of this breakout point here. It's probably going to get tested. But if you do buy 58, I think it's wise to use a wide stop. But overall, not really a great trade, plus the channel's tight. Whenever the worst thing, the best stop entries have little overlap. The worst stop entries are generally inside bars, where you have a lot of overlap. Inside bars lead to whenever stop entries in a tight trading range here or here generally lower the probability. And then here, really, really tough. If you're a bear, you get out above any bull bar. And then if you're a bull, maybe you get out below 66. And then if you're shorting, you get out somewhere in here. For me, that's generally, I see it always in that way, but I'm not going to necessarily trade it that way. For me, I'm trading with limit orders, and I'm typically just going to pick one direction. I think it's really, really difficult to, and plus I'll use wide stops and scale in. I think it's really difficult to go back and forth, because it's just easy to get chewed up. What were the best trades of the day? On the open, I generally look for the market to try and form some variation of a double top, double bottom, wedge top, wedge bottom, because that's generally what happens. And therefore, 9, it's a double bottom with 2. I thought that was a reasonable buy above 9, stop below 9, betting on a high of the day. Then when you get 2 legs up, you can get out below a bear bar here or on 21. I thought that made a lot of sense. I thought buying 31 made sense, or buying 32, stop below, holding for 2 legs up, and then maybe you get out somewhere in here. For limit orders, buyer is really, limit orders like all day. So just pick any place in the bottom third, pick any place in the upper third, and scale in. You're probably going to make money, especially if you use a wide stop. Buyers below 1, sellers above. I thought buyers below 12, scaling in lower. I thought even buyers below 19, but in a situation like that, 2 legs up, I think if you are long, you get out below anywhere in here because of what I mentioned. It's the only bull bar breaking out of the 17 bar range. It's 2 legs up in what could be a trading range. There's no follow through. It's a bad high one. Lots of reasons. I thought sellers above 24. I thought buyers below 28, even buyers below 30. I thought buyers below 36, 37. I thought sellers above 43 or 41, but I want to be a little more clear about that. I thought 41 would get retested after 42 got the breakout. In other words, 40 is strong enough for a second leg. 41 is bad follow through, and therefore 42 is probably going. The bulls are going to get a second leg up after 40. And so when you see a bar like 42, it's big. It's something. Some of you that are in Orlando, you've heard Ali call it big, small, big. I'm not really big on names with patterns, and therefore the way I see it is the same logic I'm explaining it. It's a big bull bar. It's a bull bar, climactic, with bad follow through here, and then another bull bar here. It increases the odds that the next bar is going to have bad follow through, and it's probably going to test the prior bad follow through bar. In other words, it's a spike pullback channel that converts into a trading range all within a few bars. You really want to think about it that way. I may have overcomplicated that, but it's basically the way I see it. I thought sellers above 46, but again, for me, I'd rather look to buy. I thought buyers below 48. I thought buyers on the close of 49. And then over here, I thought buyers below 53, but obviously they got trapped. But if you bought and scaled in, you were able to avoid a loss. And the reason they got trapped is here. You had a bad reversal bar, 49, and it had to get retested. And then I thought, overall, I thought buyers in the bottom third down here, and we'd probably bounce. For buy the close, sell the close, not really all that great buy or sell the close. As far as 18, you can buy the close, but it's 2 legs up in a possible trading range. When you see 19, I'd be really quick to get out around break even. And then when you see 22, 23, 24, probably sell the close for a second leg down. And then 9, 10, and 11, buy the close for a second leg up. Sell the close for a second leg down. I thought the easiest buy the close was 32, 33, 34 for a second leg up. And then all of this, really, really tough. If anything, it's a lot better if you can leg count. So look to buy after second and third legs down, look to sell second and third legs up. And if you're really determined and really, really fast, you can buy the close of something like 77, betting that will go a little bit higher. But again, I think most traders should not do that. Let me take a look at questions. And if I forgot to say it, where do I think we're going to go on Monday? We have a reversal, failed breakout of the low 2. Here's the low 1. Here's the low 2. We have a reversal bar. I think traders are going to be really interested to see what will happen with the follow through on Monday. It's possible we gap up on Monday, but if the bulls are lucky, Monday will be something strong. And then the bulls will hope for some kind of measured move. I think more likely we're going to get to the moving average and these lows up here. So I don't know if we're going to get all the way up here, but obviously the more energy the bulls can create, the greater the chances we'll get up there. Let me take a look at some of the questions in GoToWebinar. How do I trade the higher time frame daily chart? I trade it the exact same way I trade any chart. So if I was trading Forex, gold, crude, anything, I'm going to trade it the exact same way. So I haven't looked at crude oil today. I generally like 15-minute charts of crude oil. Mainly, there's not a specific reason. There's good swings. I mean, there's also swings on the 5-minute. Really, that has to do with the higher time frame. But for me, it's one of those charts I can look at and then see if there's something interesting, take it, and then focus on something like the Emini. But overall, if I was looking at this chart and how to trade it, we have a breakout and follow through reversal. It's probably going to get a second leg. So as far as buying up here, not ideal. If you did buy it and you got the spare bar here, plenty of traders will get out above the high one. If they didn't, they're going to use a wide stop and scale in. Otherwise, if I wasn't going to use a wide stop, and in other words, let's say I had a stop down here, which wouldn't be great. If I was long, I'd get out below that bar, wait for 2 legs down, and look to buy again. But over here, primarily a lot of overlap for this day. Let me see if I have. Yeah, so it's a little bit cleaner on just the regular. But overall, I couldn't remember if I had which data stream I had for crude oil on this computer. Gold. Fair breakout. So if you're lucky, maybe you catch something in here. But if I was going to trade, the way I look at charts, and I think about it all the same, whether it's a 5-minute, 10-minute, 15-minute, hourly, daily, the only difference is obviously what the incremental value is of each tick. If it's something, obviously you have to have the capital to be able to trade whatever that instrument is on that time frame. But the only thing I really pay attention to is the risk and the transaction cost. So for something like Forex in particular, I'm almost never going to trade a 5-minute chart of the Forex market. Why is that? Because the range from, this bar alone, this bar looks big, but the range of this bar is about 11 pips. And 11 pips, for me, I see the minimum scalp size generally as 15 pips. The reason I like 15 pips is it actually lowers the transaction cost. And I really don't want a transaction cost or commission to be, or a spread to be 10%. I really want it to be much less than that. So for me, I typically will trade my 5-minute equivalent is something like a 15-minute on Forex. And a lot of times I'll trade something like a 60-minute. But it all works the same way. Okay, question, Brad. If traps create breakouts, why do we need to let the other side? Give me 1 second. Okay, question. If traps create breakouts, why do we need to let the other side out break even before it can move further? Shouldn't we keep the trap? Not necessarily. So think about it like this. If you buy the close, most of the time the market's in a trading range, which means your logic of saying, so think about what you're saying. If traps create breakouts, why do we need to let the other side out break even before it can move further? That's because most of the time the market's in a trading range and breakout points get tested. In other words, most of the time, breakouts typically fail. You buy the close of 18, it reverses. But if you buy and scale in, you make money. I mentioned that all through here. If you sell here, scale in, you make money. If you buy, scale in, you make money. You get out break even here, you make money later. That's most of the time what happens. And what's key is learning how to recognize when traders are trapped. Okay, question. I was worried bar 31 here. Was a trap buying too high in a trading range? I think you're talking about a tight trading range here. By the time I waited for confirmation, It was already almost 1 hour. How do you advise on building confidence with these setups? I'm aware most things are 40-60, but there's still a lot of doubt. Well, yeah, there's, your answer, your question implies that there's lack of understanding with price action in certain categories. This is a strong enough momentum to the upside that you're going to get a second leg. So as far as saying this, that's a bull bar. If you sell it and you scale in, you get trapped on this bar, and therefore you're probably going to get a second leg. I equate it to this. If you want to learn an easy experiment you can do, again, I wouldn't do it with real money because it won't be good, but basically fade everything. So buy below 1 and scale in 3 points lower, 3 points lower, 6 points lower, 9 points lower until you make money. Sell above 9, scale in, scale in, scale in, scale in until you make money. Buy below 19, scale in, scale in, scale in until you make money. And what you're going to realize relatively quickly is if you can scale in, if you can use an extremely wide stop and scale in 6, 7, 8 times, you're going to make money on almost every trade. The problem is when you get something like this, you sell, scale in, scale in, scale in, you make money. But there's plenty of instances where you get trapped and you'd lose a lot of money. You'd lose far more than what you made. It's something like this. You buy and you keep scaling in. That'd be extremely painful. But the point that I'm trying to make is that would teach you to understand when limit order traders are getting trapped, because you are one of them. I'll talk more about that in maybe another trading room session. How do you reckon bar 31 was the best setup of the day? What can you do live to understand that it was? Well, you never know live. When you look at 31, it's a bull bar. You don't know with 100% certainty that it is going to lead to a strong second leg. But when you see follow through 32, 33, it increases the likelihood that it will be. Let me just see something real quick. Okay, question. I thought 42, 44. See, I thought the 43, 44 consecutive IIs could have gone up or down. It seemed like an inflection point. I'm not quite sure what this person's saying. So it looks like that's it for questions. So overall, Monday, it'll be interesting to see, can we get the reversal up? So can the bulls get a strong entry bar on Monday, or will it be disappointing? I suspect it'll be something disappointing, and it'll be a bad looking low one. So I suspect Monday probably won't be a strong bear bar, and it probably won't be a strong bull bar, but it'll probably be something disappointing that has buyers below it. It may be something like this. This is a much better example, much better context, but it was a bear bar, but it's a bad low one, and it led to a gap up. I don't think we're going to do this, but I do think we're going to get up to the moving average. We just don't know the path. All right, thanks everyone for watching. Hope everyone has a good weekend.